Most green hydrogen projects do not fail loudly. They do not explode. They do not collapse in public. They fail quietly, slowly, and often at the exact moment when everyone involved feels confident enough to relax. This is the most dangerous phase of a hydrogen project, and it is the phase almost no press release, feasibility study, or pitch deck prepares you for. The phase where the project feels close. Close to FID, close to financing, close to execution, close to being real. And yet, this is precisely the phase where structural failure is most likely to occur. The reason this moment is so deceptive is because all the visible signals are positive. The electrolyzer is selected. The renewable power source is identified. The site looks viable. The off-taker discussions sound promising. Advisors are engaged. Consultants are confident. Models are green. The project timeline looks clean. From the outside, everything appears aligned. From the inside, the system is under more stress than it has ever experienced. And most teams do not recognize this stress because they are focused on progress indicators rather than failure interfaces. Green hydrogen projects feel close because they are structurally complex systems masquerading as linear developments. On paper, the path looks simple. Secure power, install electrolyzers, produce hydrogen, sell hydrogen. But in reality, hydrogen projects are multi-layered systems where economics, infrastructure, regulation, financing, and utilization must all remain synchronized over time. When even one layer drifts out of alignment, the project does not fail immediately. It stretches, it absorbs strain, it appears resilient. And then at a critical threshold, it breaks. This is why so many projects stall between feasibility and final investment decision. Not because feasibility was wrong, but because feasibility did not model stress. Feasibility answers the question, can this work? System stress answers a very different question. What happens when this does not work as planned? That distinction is where most hydrogen projects collapse. One of the most common illusions at this stage is the belief that progress equals safety. When a project reaches 90% readiness on a checklist, teams assume the remaining 10% is administrative. Paperwork, formalities, legal finalization. But in hydrogen projects, the last 10% is not procedural. It is where the system is exposed to reality. Financing terms harden. Lenders impose conditions. Grid interconnection timelines become binding. Off-takers stop speaking hypothetically and start negotiating volume, price, and penalties. Incentives shift from assumed to verified. At this point, assumptions stop being tolerated. Utilization is often the first silent stress point. Early models frequently assume high capacity factors because demand projections look strong and offtake discussions sound encouraging. But utilization is not a promise. It is an operational outcome. It depends on the customer's operations, the reliability of the plant, the stability of power supply, and the absence of downstream bottlenecks. When utilization drops even modestly, the entire economic structure shifts. Revenue softens, fixed costs remain. Debt service does not adjust. Suddenly, a project that looked robust at 80 or 90% utilization becomes fragile at 60. And this fragility often only becomes visible when financiers begin stress testing the numbers. Financing itself introduces another layer of pressure that feasibility studies rarely prepare teams for. Before FID, capital feels abstract. After financing discussions begin, capital becomes disciplined, conditional, and unforgiving. Lenders do not care that the technology works. They care about cash flow reliability. They care about who absorbs downside risk. They care about what happens when assumptions miss. When lenders enter the room, optimism leaves. This transition often shocks teams who believed they were close simply because capital interest existed. Grid interconnection is another stress interface that quietly expands late in the process. Early studies may indicate available capacity, but actual interconnection queues, upgrade requirements, and timelines often reveal themselves only after applications are submitted. What looked like a 12-month path becomes 36. What looked like a manageable upgrade becomes a system-wide reinforcement. The project does not fail at this moment. It pauses, it stretches, it begins to bleed time. And time in hydrogen economics is rarely neutral. Regulatory alignment is another area where projects feel close right before they unravel. Early regulatory reviews often confirm that a pathway exists, but confirmation is not certainty. Certification regimes evolve, definitions shift, additional compliance layers emerge. What qualified as green hydrogen at the concept stage may require additional proof, monitoring, or reporting at execution. Each new requirement adds cost, delay, and uncertainty. Individually, these changes seem manageable. Collectively, they compound. Offtake agreements often represent the most emotionally deceptive signal of closeness. A signed memorandum of understanding feels like momentum. A term sheet feels like commitment. But many hydrogen projects discover too late that offtake agreements are conditional in ways that shift risk back onto the producer. Volume flexibility, price renegotiation clauses, force majeure provisions, and termination rights can turn a seemingly bankable offtake into a fragile revenue stream. When lenders scrutinize these agreements, confidence evaporates. What makes this stage especially dangerous is that no single issue appears fatal. Each problem is framed as solvable. Each delay is rationalized. Each cost increase is absorbed. Teams tell themselves that this is normal project friction, and to an extent it is. But hydrogen projects operate with thin economic margins and high capital intensity. They do not tolerate prolonged misalignment. The system accumulates stress silently until one constraint forces a reckoning. This is why projects collapse at 90% rather than 10%. Early failure is visible and educational. Late failure is expensive and humiliating. By the time a project feels close, reputations are attached. Announcements have been made, stakeholders are watching. No one wants to be the person who raises concerns, silence becomes the default. Momentum replaces scrutiny. At this point, most projects are no longer asking the right questions. Instead of asking whether the system survives under stress, they are asking how to push it across the finish line. That shift in mindset is often fatal. Pushing a misaligned system does not resolve misalignment. It accelerates failure. This is the core insight many teams miss. Green hydrogen projects do not fail because they lack progress. They fail because progress hides structural fragility. The closer a project gets to execution, the less forgiving the environment becomes. Markets harden. Capital tightens, infrastructure constraints surface. Policy certainty fades. The system is tested not by enthusiasm, but by reality. This is also why pilot success is often a misleading signal. Pilots operate under controlled conditions with favorable assumptions. They validate technical feasibility, not economic survivability. Scaling introduces entirely new stress dynamics. Larger capital exposure, tighter timelines, less flexibility. What worked at pilot scale may collapse under commercial pressure. Teams who confuse pilot success with execution readiness often discover this too late. There's a pattern here, and it repeats across regions, technologies, and market segments. The pattern is not about bad actors or poor engineering, it is about system blindness. Hydrogen is not a component problem, it is a systems problem, and systems fail at interfaces, not at nodes. This is the moment where a different kind of analysis becomes necessary. Not more modeling, not more slides, but structured stress testing. What happens if utilization misses by 20%? What happens if interconnection slips by 18 months? What happens if incentives change mid-construction? What happens if the off-taker delays ramp-up? Who absorbs the loss? Who gets paid first? Who waits? These questions are uncomfortable because they shift the conversation from optimism to responsibility. They force teams to confront trade-offs rather than chase alignment. They often reveal that the project is not as close as it feels, but they also reveal something more valuable, whether the project can survive reality. This is exactly why H2 Hub by Renewable Energy exists. Not to explain hydrogen technology, but to help professionals see where projects break before they do. Inside H2 Hub, we analyze real hydrogen systems under stress. We examine failure patterns between feasibility and FIT. We map how utilization, financing, grid constraints, and offtake interact over time. We focus on execution, not announcements. And we do it for one reason, because the cost of discovering these issues late is catastrophic. At $15.99 per month, H2 Hub is not a content subscription. It is a risk reduction tool for people whose decisions carry real consequences. It is designed for developers, consultants, investors, and advisors who do not want to learn the hard way why projects that felt close suddenly collapsed. If you are involved in a green hydrogen project that feels close, this is the moment to slow down and ask harder questions. Not because the project is doomed, but because closeness is not safety. Safety comes from alignment, from resilience, from systems that survive stress. Hydrogen will not succeed because of enthusiasm or ambition. It will succeed when projects are built that can withstand imperfect conditions. The future of hydrogen belongs not to the projects that look the most impressive at 90%, but to the ones that remain viable when reality arrives. If this way of thinking resonates with you, if you are responsible for outcomes rather than opinions, then H2 Hub was built for you. Because in green hydrogen, almost is never safe.